Thanks for clicking. All eyes were on the Bank of Canada this morning as it was set to make its interest rate announcement, with the majority of the big six banks and the majority of respondents on this channel predicting that the Bank of Canada would be raising interest rates by 25 basis points at its announcement. We got our answer at 10 a.m. this morning, and to the surprise of almost no one, the Bank of Canada did in fact raise rates by 25 basis points, bringing the policy rate up to 5% and the prime rate up to 7.2.
And I didn't see it coming.
Indeed, and the increase in the cost of borrowing is no doubt going to put even more pressure on Canadian consumers, who are already showing signs of buckling under the pressures of higher interest rates. For their part, Bank of Canada Deputy Governor Carolyn Rogers and Governor Tiff Macklem took questions following the announcement, and Governor Macklem did his best not to lose his patience with reporters. So what I want to do today is go over the interest rate announcement coming from the bank, take a look at some key points coming out of the press conference, and then discuss what to look for next. Speaking of next, we have a big week coming up with the Canadian Real Estate Association set to release June's real estate data on Friday, and we're expecting Stats Canada to release June's inflation data on Tuesday. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this announcement. On to the announcement. As mentioned, the Bank of Canada opted to raise interest rates by 25 basis points this morning, bringing the policy rate up to 5% and the prime rate up to 7.2. 7.2% prime rate. That's a long way from the 2.45 that we saw in 2020 when the bank said it would be keeping interest rates low for a long time.
I thought we both understood I was lying.
But can we expect more interest rate hikes going forward? The bank didn't say one way or the other, stating instead that it will be evaluating whether or not the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the 2% inflation target.
Don't f***ing know.
So, we don't have any hawkish language coming from the Bank of Canada stating that it will be raising interest rates for sure going forward, but on the other hand, the Bank of Canada avoided any mention of a pause, which is understandable considering after the last pause, house prices skyrocketed upwards. And Governor Macklem actually addressed that pause at the press conference.
Do you think that it was a mistake in your messaging in January to say that? Should you not have maybe just said, we're not raising rates today, but we're going to keep watching things?
The governor does always seem to appreciate getting Monday morning quarterbacked by reporters, doesn't he?
We've seen an accumulation of evidence pretty consistent across a range of indicators that there's more excess demand in the economy. Excess demand is proving more persistent. Underlying inflationary pressures are proving more persistent.
So the governor is saying that back when the bank did its pause, it was expecting that Canadians were going to slow down the spending, that it had done enough to dissuade consumers from spending more. And, obviously, it hasn't yet. With that said, the Deputy Governor and the Governor were then asked about a recent report coming from MNP showing that Canadians are struggling with the higher cost of borrowing and inflation.
Regarding the box on household financial health and the strength in consumer spending, you say there's a smaller portion of households who are experiencing financial stress and that many households remain healthy. In a way, it sounds too good to be true, but I would think this is contributing to the consumer spending, which remains strong. But how does this match up with other reports of more than half of Canadians being less than $200 away from being able to pay their monthly bills?
See how the governor nodded to Rogers midway through the question? You do kind of get the idea that the bank knows full well which questions are coming at them prior to the press conference. Regardless, the Deputy Governor said that the bank sees the same headlines as we do, and they are well aware of the problems facing vulnerable Canadians.
Well, I mean, Ro, we see some of the same headlines that you see, that you're talking about, but we know that inflation and interest rates, the response to inflation, affect people very differently. And in particular, we know, we have said this many times, we know that the most vulnerable Canadians are the ones that are hurt most by both by inflation and by higher interest rates.
And we've seen in article after article over the past few months the negative effects stemming from the higher cost of borrowing, but also from inflation. And the message coming from this press conference, at least, is that the bank is well aware of the problems that Canadians are facing, but there isn't a whole lot that they can do about it.
There's no easy path to restoring price stability. We understand that inflation's a burden on Canadians. And we also understand that higher interest rates are squeezing many Canadians.
It's either me or them.
So the bank understands full well the pain that it is causing, And we've talked about this before on this channel. This isn't a surprise at all to the bank. This is very purposeful. They are trying to weaken demand. They are trying to forcefully cause a slowdown in spending. And finally, the bank was asked the question that we all knew was coming in the aftermath of the release of last month's CPI, when StatsCan showed that if you take out mortgage interest costs, the CPI is sitting at 2.5%. So the question that we've been hearing from the usual suspects and at this press conference is the Bank of Canada doing more to hurt inflation by raising the cost of borrowing than it is to help?
Rate hikes have contributed to inflation through increased mortgage costs. At the same time, fewer homes are being built because financing costs have gone up. How do you factor that into your thinking and whether rate hikes are making inflation and supply shortages worse?
And on this, Governor Macklem offered a rare bit of well-intentioned sarcasm.
And of course, if you take things out of the CPI that are going up, what's left is going up more slowly. So yes, if you take mortgage interest out of the CPI, instead of 3.4, you're left with 2.5. On the other hand, if you take things out that are falling, what you're left with is going up. For many Canadians, gasoline is a major expense. If you take gasoline out, what's left is going up at 4.4%.
And yeah, he's not wrong. The Bank of Canada is concerned with general inflation, not specific inflation. They're concerned with inflation across the board. I don't think if you talk to many Canadians at the grocery store or looking for an apartment, I don't think many of those Canadians would say that the bank's job is over, which Governor Macklem addressed earlier in the press conference.
Meat's up 6%, bread's up 13%, coffee's up 8%, baby food's up 9%, hotel prices are up 13% from last summer, restaurants up 7%. So,
with that said, the higher cost of borrowing is doing more to hurt than help argument is likely to persist, as evidenced by the fact that it was asked yet again at the end of the press conference.
If you strip out mortgage costs, inflation is actually within the target range. So can you explain to Canadians who aren't economists how making those mortgage costs even higher is going to help bring down the cost of living? Do you worry at all about losing credibility with them, with the seeming disconnect between making things more expensive so you can make things less expensive?
You can just tell they're a little frustrated by having already answered this. But the reporter asked that the response come in French.
And if you can, give me an answer in French if possible. Thanks.
And, although I don't speak much French,
Is a disappointment and my greatest failure.
I was able to pick out a couple of words, especially since I heard them a few minutes prior.
Rents, 6%, les hôtels, 13%.
Like we said at the beginning, trying to avoid frustration. So, in summary, the Bank of Canada raised interest rates by 25 basis points this morning, bringing the policy rate up to 5% and the prime rate up to 7.2%. And, judging from the press conference, it's well aware of what these interest rate hikes are doing to Canadians, but it's also well aware of what high inflation is doing to Canadians. It's not as though they don't know. It's not as though the Bank of Canada didn't see the release coming from StatsCanada. It knows full well that, for at least May, if you take out mortgage interest costs, it looks like the CPI is sitting at 2.5%. But it also knows full well that 1, this is largely due to base year effects, and 2, that a lot of what Canadians rely on, a lot of what Canadians care about, such as food inflation and household goods, is rising at a rate above 5%. And, as such, it's likely that the bank is going to continue to keep a close eye on Canada's inflation rate going forward. The bank didn't signal that any more interest rate hikes are going to be coming down the pike anytime soon, but they also didn't signal a pause. As they've said over the past year, over the past few months, it will be data dependent going forward. It will all be dependent on the economy and on the inflation rate and on inflation expectation. We will obviously continue to have updates out on Canada's real estate market and its economy and its inflation rate on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.